Most people think making money in the stock market is about being smart, fast, and lucky. But here's something strange. One of the greatest investors in history didn't build his wealth by predicting the future. He built it by avoiding mistakes that most people don't even realize they're making. And the crazy part? He learned these rules not from Wall Street, but from a book. A book called The Intelligent Investor by Benjamin Graham. And that investor? Warren Buffett. Today, we're breaking down 5 powerful rules Warren Buffett learned from that book. Rules that can completely change how you think about money, investing, and wealth. And before we go deeper, if you enjoy simple, story-based finance content like this, subscribe to the Asset Avenue Club, where we break down money in a way that actually makes sense. Let's start. Here's the problem. Most people treat investing like a game. They chase hot stocks, they follow trends, they panic when prices fall, and get excited when prices rise. It feels logical, right? Buy when things are going up, sell when things are going down. But that exact behavior is what quietly destroys wealth. Because the market doesn't reward emotion, it rewards discipline. And this is exactly what the intelligent investor teaches. Rule 1. Don't follow the crowd. Imagine this. A stock suddenly becomes popular. Everyone is talking about it. Your friends, social media, news channels. It feels like you're missing out. So you buy. But here's the problem. By the time everyone is excited, the price is already high. Warren Buffett learned early that the crowd is often wrong at the worst possible time. When people are greedy, prices go up too much. When people are scared, prices drop too much. The smart move? Do the opposite. Not emotionally, but rationally. Because the market is driven by human psychology, not logic. Rule 2. Think of stocks as businesses. Most people see stocks as numbers on a screen. Green means good, red means bad. But Buffett doesn't think that way. He treats every stock like a real business. Imagine buying a small shop in your city. Would you check its price every hour? No. You'd focus on, is the business growing? Is it making money? Does it have a strong future? That's exactly how Buffett looks at stocks. Because when you stop thinking like a trader and start thinking like an owner, everything changes. Rule 3. Mr. Market is emotional. Benjamin Graham introduced a powerful idea. He said, imagine the stock market as a person called Mr. Market. Every day, Mr. Market offers you a price. Some days he's optimistic. He offers very high prices. Other days, he's depressed. He offers very low prices. And here's the key insight. You don't have to agree with him. You don't have to react. You can simply ignore him or take advantage of him. But most people do the opposite. They let Mr. Market control their decisions. They panic when he's scared. They get greedy when he's excited. Buffett learned to treat the market as a tool, not a guide. Rule 4. Margin of safety. This is one of the most powerful ideas in investing. Let's say something is worth 100 rupees. Would you buy it for 100? Or would you prefer to buy it for 70? That difference is your safety. It protects you from mistakes, because no matter how smart you are, you can still be wrong. The margin of safety gives you room to survive those mistakes. Buffett didn't try to be perfect. He just made sure he wasn't paying too much. And over time, that simple habit protected his wealth and helped it grow. Rule 5. Patience beats intelligence. This one surprises people. You don't need to be a genius to build wealth. You need patience. Because investing isn't about quick wins, it's about time. Think about planting a tree. You don't dig it up every week to check if it's growing. You give it time. But most people do the opposite with money. They keep checking. They keep changing. They keep reacting. And in that process, they destroy the very thing they're trying to build. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." So, what should you actually do? Start simple. Don't chase trends. Don't panic during market drops. Focus on quality, not hype. Think long-term. And most importantly, control your behavior. Because the biggest risk in investing is not the market, it's you. At the end of the day, Warren Buffett didn't become successful by doing something complicated. He became successful by avoiding simple mistakes over and over again. And these 5 rules, they're not just for billionaires. They're for anyone who wants to build wealth slowly, steadily, and intelligently. So the next time you think about investing, ask yourself, are you following the crowd? Or are you thinking for yourself? And if you want to keep learning how money really works, subscribe to the Asset Avenue Club, because the more you understand money, the less it controls you.